Well, good morning and welcome to the Russell Investments Investor Conference. My name is Matt Arnold and I'm very pleased that everyone can join us today for what should be a very good session. Before I introduce our panelists, just a couple of comments about the event over the next couple of weeks. So you will have received invitations and brochures. So as described there, we're going to have 8 or 9 sessions. Most of these will be in the webinar format, but we will have 2 live sessions. Wellington tomorrow afternoon talking about ESG, and next week in Auckland. So for those of you in Wellington and Auckland, it would be great to see you there. So I'm pleased to be joined by Pete Gunning, who most of you will know. He is Vice Chairman of Russell Investments, and he's going to kick off the conference with a brief discussion on the last 12 months, obviously being a pretty crazy one from market perspective. And then we will have the key session from our Global Chief Investment Strategist, Eric Ristabin, who will be talking about market action over the last 12 months or so. Most of you are pretty familiar with Zoom by now, but just a reminder, you can ask Q&A or questions by touching the Q&A button at the bottom of your screen. I will endeavour to ask all those questions that come in. The session will last for about an hour. It will be recorded as well. So with that, maybe just hand over to Pete. Pete, good to see you. Has been a crazy 12 months or so. Maybe you can kick off with your thoughts on the last year or so and how Russell has navigated pretty crazy times.
Sure, thanks, Matt. So thanks for all of you that are joining us. As Matt says, it's certainly been a crazy year, and we certainly appreciate your support throughout it. I also just wanted to acknowledge Alistair. I don't know, Matt, whether he's dialed in or not, but many of you may have heard, hopefully by now, that Alistair, after over a decade at Russell as a fine leader in New Zealand and more broadly, has taken, like many of us have during COVID, the opportunity to reevaluate priorities, and he's decided to take a bit of break from the industry. Timing maybe not completely unexpected given the beginning of the ski season, but we certainly wish him well, and we certainly know that he will remain a friend of Russell. But you're absolutely right, Matt. It has been a crazy 14 months. I actually joked with the US Mutual Fund Board when I came back as global CIO the second time round, and said to them, don't worry, it's not going to be like last time I joined, which was back in late 2007. And clearly after a bit of a hiatus, we moved into the GFC, and surprise, surprise, a few years later, we get hit with a global pandemic. I think this time round, though, and Eric can certainly attest to this, it was a little scarier because it wasn't just financial markets that were getting a little wobbly. It was also, obviously, in the background, health issues as well. Nonetheless, what we did to a large degree was sort of dust off the old playbook that we'd used back in sort of September of 2008 onwards. So we reinstigated the weekly meetings, the war room, so to speak, to make sure that we were completely on top of what was happening in the markets. The thing that sort of was threw a bit of a spanner in the work, though, was at the same time, we suddenly weren't able to go back into the office. And fortunately, for many years, Russell has been able to work from home. So that wasn't an unusual occurrence for us. Clearly, it was that we weren't able to get back into the office. And really, outside of the Aussies and the Kiwis, things are still a bit of squirrely around Russell World. I mean, people haven't been able to get back into many of our offices, particularly in the US and the UK. Nonetheless, we were able to, maybe even to our surprise, function really well. And when the dust settled and we got into the pitter patter, by the end of last year, we'd done record volumes of trading. And we did that having everybody, including the traders, at home. So the systems were certainly working, the plumbing was certainly working. The other thing that made life a lot easier for us over the period was, after the GFC in particular, we spent an enormous amount of money on systems, particularly risk systems. So we had a very, very clear understanding of where our portfolios were positioned, and having that real-time information certainly gave us a lot more comfort. Without talking too much out of school, we were a bit concerned at one stage about some of our counterparties, and not so much because that we thought that there was going to be untoward in terms of defaults, but when markets were really whippy, particularly in March, there were a lot of margin calls, and many of the counterparties that we dealt with had outsourced operational functions to India. And while the internet works pretty well in Auckland and Wellington and in Sydney and Seattle, when you're in Mumbai and New Delhi and Bangalore and places like that, it doesn't necessarily. So working from home there is a little different from us working at home. But nonetheless, we ended up getting through it in pretty good nick. We're sort of glad to agree that that's certainly almost behind us. The other thing that was pleasing, and Eric will touch on this to a degree as well, is we had some pretty firm beliefs in terms of portfolio positioning going into the squirreliness, the global pandemic, and notwithstanding the fact that markets really moved against us, we stuck to those levels of conviction, and importantly, that has definitely paid off for our clients. So we saw a very, very strong rebound in terms of fixed income performance quite early on in the piece, and then more recently with rotation out of some of those really expensive large growth names, particularly in the US and in China to a degree for our emerging market funds. That rotation is certainly helping performance as well. So we certainly would love to see the continued back of it. We certainly want to see the opening trade continue from a human aspect. We clearly want to see vaccines rolled out and some of the devastation in some countries go away as soon as possible. But from an investment perspective, it was definitely an interesting time, somewhat of a Chinese curse, but we managed to get our clients' portfolios through it in pretty good nick by the end. But that's enough of the past. Perhaps a great time, Eric, if you want to join us to introduce Eric, who Eric and I have worked together for 25 years, I guess, so quite some time. He always has sage advice, and I'm looking forward to his session. So thanks, Eric.
Thank you, Pete.
Yeah, thanks very much, Pete. Okay, yes, over to Eric, who, as I mentioned, Chief Investment Strategist. Eric's got his vaccine, so he's looking pretty happy there, and we'll be heading back to the office soon, we hope. So, Eric, over to you. And again, please feel free to ask questions. We'll get those answered throughout.
I was sharing with Matt in the run-up to starting this that I actually haven't been in our office in Seattle since March 11th of 2020. So I for one am actually looking forward to going back in the office. It'd be really nice to see the people in person that you work with. and we're very much looking forward to that. And yeah, I also point out that the team there in Auckland nixed the title that I had on my presentation, which was "Glad That's Over," and then it, unfortunately in the subtitle, "Hopefully." So we're going to talk a little bit about kind of a little bit of what's happened, is because past is prelude, as always. I think I've probably told you in the past that I'm the son of a history professor, so I do need to visit the past to give context to what we're seeing today. But we're not going to spend a lot of time in the past. So let's kick it off with kind of what we see right now. If I can get, there we go. So obviously, the health crisis, the pandemic, created a negative market and economic reaction. The economic downdraft in New Zealand was actually, it looks extraordinarily high, but trust me, relative to the rest of the world, your downdraft was actually fairly minimal. And that's, I think, because island living does have its advantages, so that you have, as it turns out, a really awesome moat as it relates to things like pandemic, as does Australia. Not sure why Britain had so much difficulty, but we'll leave that up to them to decide. So the reality is that there was a major economic downturn that created a whole host of dislocations across the world. In response, and I think this is the important thing, that we all know, but constantly have to keep in context. In response to this economic downturn and the economic devastation potentially that could have wrought on the broad global economy, and in particular the consumer writ large across every country, every particularly developed nation country, if consumers end up being financially crippled by the health crisis, then the recovery is going to face extraordinary challenges. So policymakers, I think, need our thanks by and large, and that's across the globe. When you look at the total monetary and fiscal stimulus response to this economic downturn, on a global basis, it equates to roughly 31% of global annual GDP. In the US, that number is 41%, and that's before the two new packages that the Biden administration wants to bring to Congress a little bit later in this year. So a truly astronomical amount of stimulus has hit the system. I'll use the US as kind of the to give you a sense of kind of what that's done in terms of setting the stage for what we've seen in market performance over the last 9 months, and in particular over the last 6 months. The American consumer, if you looked at them at the end of March, they had $2 trillion in incremental cash reserves in their bank accounts and other locations, but principally their bank accounts, because of one, the stimulus checks, two, the increased unemployment benefits, but also due to the fact that they had to defer consumption, particularly in things like services like restaurants, hotels. You can get a sense in the US, the hotel industry has been absolutely a ghost town. My son actually works for the largest hotelier in the States, maybe in the world, Marriott Corporation. And they were running for a lot of the year at 25% capacity. So there's been a lot of economic pain in those sections of the market. And then that's important because there's a lot of money in the hands of consumers in the US, but globally. And there is this expectation when the time came that they would be in a position to go back to roughly their normal lives, that they would spend that money freely and potentially, as we often do, maybe even in excess. So that's an important backdrop. But really, if you want to really think and take a look at the last 6 months in terms of market performance, it's really framed by the vaccine, right? If you look at market leadership, since particularly November 9th, here in the States, that's when Pfizer and BioNTech made the announcement of the efficacy of their vaccine late stage testing. That set very much kind of lit the fuse of what we refer to, and not only us, but broadly people are referring to the reopening trade. The market, was beginning to anticipate a return at some point in the not too distant future, maybe in the next 6 months, maybe in the next 9 months. It'll depend by country, by the way. and that really has a lot to do with vaccination rates. But at some point in the not too distant future, much of the U.S. economy, much of the global economy is going to get back online, fueled by the vaccine and the ability to actually interact without exacerbating the health crisis. That reopening trade is a kind of a classic scenario. It's typically what you see when you get to the bottom of an economic recession, at the trough of economic growth. That recovery trade and that reopening trade have a lot of consistent markers. And what we've seen in the last 6 months pretty much checks the box on all of them, right? So when you're going to see the economy experience higher growth rates and see positive momentum in the global economy, you see cyclical stocks beat non-cyclical stocks, and specifically value stocks beat growth stocks as a general rule. That opening trade and that reopening trade is usually very friendly to value stocks. But cyclical stocks in general, which means non-US, tends to beat the US market because non-US economies are more cyclically oriented, and therefore the revenue streams of the corporations are more cyclically oriented than the US market. It's one of the opposite is true as well, because the reason the US tends to do well in a major negative economic event is because our stocks don't have as much sensitivity to cyclicality as other parts of the world. The other thing that you typically see in and by the way, small cap stocks have beaten large cap stocks, value stocks have beaten growth stocks in the US and everywhere. The other thing that typically happens is interest rates rise as people begin to price in greater economic activity, as well as the potential for inflationary pressures building in the system. That happened, led by the United States. Typically, primarily, sympathetically, everybody's yields went up. The reserve currency status of the US dollar means that when our rates tend to go up, we tend to effectively export inflation or changes in inflationary expectations. You guys saw it in New Zealand. You saw your 10-year yield rise. Australia saw it very sympathetically, very similar to what we saw in the States. You saw in Australia, Canada, and New Zealand, less so in Europe and less so in other parts of the world, but clearly in your neck of the woods, you definitely saw that happen. The vaccine rollout obviously for you all is going to be later in the piece, but you don't have the kind of health crisis currently. You've done an excellent job of controlling the pandemic itself. We haven't done a particularly great job in the States. So the vaccine is much more of a game changer economically for us. I think that would explain some of the performance of the US market relative to, say, your domestic equity market. Your composition is going to be a little bit different. The Novavax has not even been approved. They haven't even submitted it for approval in the United States. There's a really good reason for that. By the time they actually get it approved, almost everybody in America will be vaccinated. The US is actually, probably by July, we will become a massive exporter of vaccines to the rest of the world as we move into more of the mop-up stage in our vaccination efforts here in the States. And so to give you a sense of scale, we are currently vaccinating 3 million people a day in the United States. 247 shots have been administered. 31% of the US has currently had both doses, are fully vaccinated. 43% have at least received one dose. So we're not too far away from becoming a massive exporter of vaccines to the rest of the world. So that expectation that AstraZeneca is going to prove to be a large portion of your vaccine pool is probably a really good expectation, because we'll be exporting in the very near future. Business confidence has also risen. That is not surprising. Businesses also look at the press clippings, and they're also expecting this return to normality in terms of economic activity to actually manifest itself in 2021. And they're beginning to anticipate that both from a business confidence and a trade perspective. The UK and the US are ahead of the rest of the world. Israel is the farthest ahead, but the two larger economies, the US and the UK, are ahead of other countries. The UK has more people that have received at least one dose as a percentage of their population, but because they lengthen the period between the two-dose vaccines, they actually have a lower percentage than the US does of fully vaccinated people. The European Union is beginning to accelerate its pace of vaccination. They have had a very slow start to the vaccination. The part of that is production and vaccine availability. There's some other logistical issues as well as probably sentiment related issues, but that pace is picking up and they're actually gathering significant momentum in Europe. It looks like in the third quarter, Europe will basically be in the position that the US is in currently as it relates to the vaccine effort as the broad population. So there's a lot of actual news in the vaccine front that is meeting the expectations people established on November 9th. Asset class performance also, as I mentioned earlier, is reflecting that reopening trade. The Euro stocks have actually had some of the best performance from a New Zealand investor's perspective. The Russell 500 value or the S&P 500 value is also a top performer. This is that, and commodities are doing well. This is that kind of elements of that classic reopening trade. Bonds in general had a very bad quarter because rates rose in the United States. Spreads have dramatically compressed on the credit side of the ledger globally and specifically in the largest credit market in the world in the United States, to the point where those spreads are actually fairly narrow, and there probably isn't a lot of remaining juice and spread compression left in credit. That said, there are probably those premiums of yield that they're offering relative to treasury instruments and sovereign instruments are actually probably on more firm ground with economic conditions improving than they were. So the idea of overweighting credit to clip the yield on an incremental basis to outperform the broad benchmark, I think that proposition is still well in place. We think that proposition is well in place. But you're not going to get the price movement of spread compression that you've gotten over the last, certainly since November 9th, and it's been pretty significant. Leadership has widened. We talked a lot about the unbelievably concentrated nature of global equity market leadership. To a large degree, that leadership came from the largest 5 companies in the S&P 500 index. We kind of looked at what was driving performance at the end of the year ended September 30th of 2020, so just 6 months ago. When you looked at what had been driving performance for the prior year, it looked like the US was dominating every other market in terms of performance because the US was far and away outperforming on a cap weighted basis. The interesting thing is on the equally weighted basis, they weren't. The average US stock actually in that year underperformed in the US versus their non-US peers. What drove US dominance in that period in terms of return dominance was in fact those top 5 companies in the S&P 500, all of which are mega cap tech stocks, all of which have benefited greatly from the shutdown trade, where people were living their lives more virtually than in reality, and that was really supportive and conducive to their revenue models. Now, that there is an argument to be made, and we would be one that would be making it, but I think you're beginning to see it actually show up this year so far, is that a lot of those earnings that they've gotten, that massive windfall of earnings from the shutdown trade that a lot of these companies received in 2020, were actually pulling earnings and revenues forward from future years into 2020. Effectively, Netflix, I think, is a good example of that. Netflix had a very good number in terms of its reporting, but their stock didn't react positively because the number of subscribers fell. You're kind of Netflix in not to put too fine a point on it, but Netflix in their largest market, the United States, is kind of running out of people to sell Netflix to. Most American households by far already have Netflix subscriptions. They're also almost all members of Amazon Prime. So their ability to kind of grow their segments of their business in the US are becoming more and more limited. Therefore, they need to continue to drive growth primarily outside of the United States and in many ways for those companies. But we still see those parts of the market as being extraordinarily expensive in terms of those large cap, mega cap tech stocks. The good news over the last 6 months is the market's beginning to move away from leadership. Last year, 51% of the S&P 500 was actually due to those 5 stocks. The numbers on a global basis would be equally staggering, although smaller. Of the total aggregate global equity returns last year for equity companies, they were a quarter of the total return, actually a little bit north of that. So they had a profound impact on returns last year. This year, relatively small portion of those returns are being driven by those larger companies. As market leadership is beginning to broaden, that has a lot of that sets a good stage for small companies. It sets a good stage for small companies to outperform, value companies to outperform, because they are not mega cap in almost every instance. The other reality is that it also creates an environment where active management, active portfolio management relative to passive investments has a much higher probability of being able to generate positive returns. And in many cases, and in almost most of our cases, when we look at our manager kind of stock selection component of the return, that's been significantly positive over the last 6 months. And we would kind of generally expect that trend to hold for the rest of the year, because, and I'll show you a little bit later, although those companies have not, those mega cap techs have not led to the last 6 months, they still are extraordinarily expensive on a relative basis. Yep, Matt, you have a question?
Yeah, just back on that other slide, that's a pretty astounding stat, the amount of last year's return that was attributable to those top names. If we look at this year, there has been speculative excess with some of the junky names that have recovered, the AMCs and those types of stocks. Any sort of thoughts about that with regards to the sustainability of the broad market recovery?
So when you see the kinds of returns that we've seen for the last calendar year, and they're extraordinary, particularly from the bottom of markets, which was a little bit, we're 13 and a half months on from the market bottoms. It is not unusual for pockets of irrational exuberance to exist. I think the meme stocks, the AMCs, the ones covered by Reddit, the GameStop stocks, are part and parcel of kind of this really strong, borderline euphoric rally. I made the tongue-in-cheek comment that Reddit is the new boiler room. For those of you that aren't familiar with the concept of a boiler room, they were quite popular, particularly in the United States in the 80s. And basically it was, and this still happens with disturbing frequency, smaller, generally less reputable brokerage firms begin to pump up penny stocks and be able to show massive gains in penny stocks because they get their clients to be a dominant part of the available daily float on those stocks. They pump them up and then eventually everything ends in tears. So I think GameStop is probably the poster child in my mind of that movement. This is a company that went from expected bankruptcy to 100-fold share return. I don't care how much better they were going to do than bankruptcy. 100 times share return seems to be out of the pale. And by the way, it's an old school brick and mortar company that sells physical game cartridges. So it's interesting. If you don't know why a stock price is moving up or down, it's usually never a good idea to buy them. And most of those stocks fall into that category for me, Matt. And we were talking a little earlier, we have seen a little bit of a retrenchment this month. Growth has actually shown a little more dominance this month, not anywhere near enough to make up for the last 6 months. But given the results that some of these companies are posting in top line and earnings numbers, that's not unexpected. It is, however, if you take a step back, it is important to note that in the United States and in Europe in particular, those two markets, when you look at those companies in first quarter earnings, they were hoped to be very strong because of a return to more normality in the broader economy. They have been extraordinarily strong. And there was an expectation that value stock earnings growth would be greater than growth stock earnings growth. And even with the recent reporting of some of those FANG stocks, that actually has been very solidly the case, and we would expect it to continue. It's just that, you know, those companies and value companies tend to be in more cyclical industries and benefit disproportionately from reacceleration of economic activity. That was the expectation established in that run in the end of fourth quarter and probably in at least the first month and a half of this quarter. And that actually turned out to be the reality of the earnings story. So expectations have been actually met by real data. We would expect that trend to continue. And I'll give you, for this reason, this is our outlook economically. And then I'll talk about some of the scenarios that we haven't. So this is our central scenario. In the next chart, it'll be the neutral scenario, which is, it's not neutral. We are expecting the United States, with a consumer base that has $2 trillion in incremental cash on hand, to grow at a 7% GDP growth rate. That's a number that we haven't seen in the United States since 1984. That is a number that is 4 times what we think long-term trend growth capability of the US economy is. We think the US economy trend growth rate, it looks more like 1.7 a year. This number is 4 times that size. And by the way, there's probably, if you were to ask me on the over-under on 7%, which do I think the number is going to be over 7% or under 7%? I'd choose the over, and I'll come back to that in just a minute. The Fed is reiterating on every occasion that they have no intention of changing monetary policy anytime soon. The expectation is that next year they will begin probably, to phase in the end of quantitative easing, meaning they will begin to not purchase $120 billion a month. They'll purchase less, so they'll taper effectively throughout. But that will probably take roughly a year if the past is any indication of how long it will take them to wind that down, which doesn't really put them in a position to raise interest rates probably until late 2023, early 2024. Things could change, but at this point, that's the expectation. The Eurozone, we're expecting to put up a 5% growth rate, which I assure you all the superlatives I said about a 7% growth rate for the US apply to a 5% growth rate for the Eurozone. And Asia Pacific, which was less impacted directly by the pandemic because they were broadly more successful, the notable exception, India notwithstanding, but broadly, Southeast Asia in particular was very effective at controlling the pandemic and its implications to their broader economy. They're going to benefit primarily from their 2 biggest customers, Europe and the US, getting significantly better. We do like, in terms of our preferences, we do like non-US over US equities for a number of reasons. The first of which I've already hit on, which is the valuation of the US stock market is still very, very expensive. The rest of the world is either moderately expensive or expensive. So we're really expensive. The rest of the world isn't cheap, but they're not as expensive as we are. The other reason for the preference to non-US is that there's a couple of reasons that support non-US exposure. There's an industry composition, which I'll show a little bit later, that shows you that non-US markets have more of a cyclical composition to them. I've made that point several times. I'll show you the data in just a moment. And the last thing is our expectation is the US dollar is going to weaken, which it normally does in this opening trade. It has been until the first quarter when our rates rose more than everybody else's, but that was more of a one-time thing. And we think that is largely over because our inflation expectations are actually very muted for the next 12 months. although I'll talk a little bit more about it in detail. Yes, Matt.
And yes, Eric. So we've got 4 or 5 questions on interest rates. So it's obviously a sort of key topic. I'll sort of summarize them. So we've seen rates on, the US 10-year back up aggressively and then kind of come back a bit. So we're saying that we don't think the Fed will raise rates above where they are today until late 23, early 24 at the earliest. So that's quite a long way out.
Yeah. Be very aware that that's an expectation. I wouldn't go to Las Vegas or Macau anytime soon and put a lot of money on those specific dates. But right now, that's where we think they are.
And do what might change that? So you're hearing sort of anecdotal evidence that people just really want to get out there and spend. You mentioned all the money they've saved, etc. So if you have a sort of 9%, 10% GDP sort of number, would that bring things forward?
It may. So one thing, just kind of as a backdrop to kind of our view around capital markets, is informed by the fact that we are very early in this economic cycle, right? We just had a recession, actually a rather deep one, if not the shortest lived one ever, but a very deep one. Normally that early part of the cycle is enormously supportive of equities. It's not all, it doesn't mean there won't be volatility. It doesn't mean there won't be corrections. There will very likely be corrections in the next 12 months. We just don't think they're going to hold because the weight of economic momentum is such that they're going to continue to pull stocks that go into correction territory back up. To directly address your question there, Matt, what would change is first of all, we think there's a really good chance that there's an even more bullish scenario than 7%. So when I said, if you're going to bet well, that's because we think there's a really big probability that there's even going to be a stronger economic recovery than the 7% for the US and 5% that we have priced in for Europe. And those would be those are the ones that had the most negative impact of the pandemic on their economies. Your drop, as I mentioned earlier, was not as significant as ours or Europe's. Europe's was less significant than ours. I don't know if that's I don't know if that's something we want to lead in, but we had a really negative result economically. That bullish scenario could potentially move into putting pressure on the broad economy, inflationary pressure. But you got to eat through the available slack, the economic slack that exists. And even though unemployment in the United States has fallen dramatically from our 14.7 high in April, we've actually down to 6% unemployment, which is a massive improvement. But that's a year, at the end of 2020, or 2019 rather, at the end of 2019, we were at 3.5. So we're still 2.5 percentage points in unemployment, 2.5% more unemployed people than we had, a year and 4 months ago. That slack in the employment market probably is going to take a while to eat up. In fact, it's important to note that when we saw about 1 million jobs created in the United States in March, Powell the very next day came out in a press conference and said what he would like to see, what they would like to see on the Open Market Committee is 6 straight months of 1 million jobs being created in the United States. That is an extraordinary amount of job creation. So the neutral scenario is already expecting a tremendous amount of improvement in employment in the United States. We also are running our overall utilization numbers in the States. Again, we had the biggest hit, so we're the farthest away as a general rule from where we were. Even still, our capacity utilization is about 5% lower. We got to effectively economically, you kind of got to blow through all of those, all that slack to see sustained inflationary pressure. We are going to see inflation numbers in April and May that look startlingly large, but that's not really real. That's a basis issue, meaning that when you have an inflation growth rate, it's this year's price level divided by last year's price level. Last year's price levels were horrible in Europe and the US. And so that division ends up with a bigger number than a smaller number, and I think may cause people, and again, Jerome Powell, the chairman of the Fed, has reiterated his expectation that that's going to occur several times. So, in order for inflation, our minds, to really become a serious issue in the next 12 months, you've got to see just an absolute blowout of those numbers. And even then, you may not be able to go through all of that slack. Now, I've been really clear that our sanguine kind of view of inflation is like a 12-month view. It is not a 3-year view. There is every probability in the world that inflation is going to heat up. Every possibility in the world that heating up of inflation actually drives the Fed to move closer than they expect now. It just doesn't look likely in the next 12 months. But watch that space closely, because those will be some of the most watched statistics by ourselves and others over the next 12 months. And again, the U.S., and I always feel really awkward as an American talking about the U.S. so much, but it is the reserve currency, and we have a long and rich history of exporting inflation to other countries. So, your biggest inflationary risk is us. I had a long conversation with Greg Knott, who's our fixed income and multi-asset portfolio manager and CIO of Canada, and he was saying, yeah, that's my biggest concern about inflation is America getting an inflation problem. So I'll actually go to this one, because I think this chart, and I'll come back to the other ones, but this is what we think happened in the first quarter. Effectively, we saw the rate rise. We think this is what the Fed thinks happened in the first quarter, just kind of parsing out some of their statements. Really what happened in the first quarter in our minds, and it happened a little bit in the fourth quarter, but it was very dramatic in the first quarter, was the market for the 10-year, the 10-year Treasury market. This is our TIPS, our Treasury Inflation Protected Securities marketplace, where you can infer inflationary expectations from where the market is. Basically, what we think has happened is the market went from a really kind of a ridiculous and unreasonably low inflation expectation below 1% to something that looked a lot closer to the Fed target of 2%. So we think that was a kind of a step function repricing of expected inflationary pressure. And when it happened, we said we don't think it will continue, and it hasn't, right? In fact, you noted that there has been a rally in sovereign bonds for the last, say, 5 weeks, 6 weeks maybe, and that I think is just that a little, in our minds, actually a little evidence that step function was more of what happened in the first quarter than a sustained push on inflationary expectations. So that's kind of our inflation view, massively simplified. The U.S. dollar, again, because it's a counter-cyclical currency, meaning that when the world is fearful about the existence of the global economy, it ends up buying the dollar. When that fear abates, it tends to sell that dollar, the U.S. dollar, and you see the dollar weaken. That's obviously supportive, in kind of broader terms of performance of other countries, other regions, securities, because their currencies are getting more expensive. And so when you repatriate your non-New Zealand exposures outside the United States, you get to repatriate them for more New Zealand dollars than you would have if the numbers had run the other way. And then this gives you a sector composition area. Basically the thing to look at is technology, information. It's 27.5% of our economy, and I apologize for the very American labeling of this chart. I should have changed it to non-US rather than international. But suffice to say, the rest of the world, only about 9% of their market capitalization is in that space. So you see the disproportionate percentage of our capitalization that's in that tech sector, and the vast majority of that is mega cap tech. We've seen instances. Canada has a disturbingly similar picture because of one company. We've seen this picture before. Those numbers usually don't stay that high in the States. There is a reversion back to the mean, and that in our minds is that mega cap tech bubble, kind of those valuations reverting back to more normal levels, reverting back to mean levels, and we think that will happen. But again, more cyclical sectors benefit from an economic recovery scenario, and we expect a very strong economic recovery scenario. That's a non-US versus US preference.
And Eric, we've got a couple of questions on sort of emerging markets. What our forecast is for those markets? They're typically the most cyclical areas of the globe, but you have some pretty dire situations on the ground in India and Brazil. What's our outlook for EM, given it's pretty cheap? It should be cyclical, and you should have that recovery commodity story as well, but you have those pretty tough conditions on the ground currently.
Yeah, I think our regional preferences really can be really cleanly described as our regional preferences in terms of stocks is anything but the US. In a word, and certainly anything but mega cap tech growth US. We're a little more sanguine about value exposure in the US, but still, the point holds. We're expensive. The emerging markets, yeah. First of all, there's a lot of heterogeneity in the emerging markets. Some countries are in very good nick from a health crisis standpoint. Others are not. That's the way it always is in emerging markets. It's an incredibly heterogeneous group of countries. In general, we have a very constructive view on emerging markets, right? There's a couple of things. One, this cyclicality. Two, the fact that the vaccination effort in the United States and Europe will largely, hopefully, and the numbers support this hope. Hopefully, the U.S. and Europe will be largely done vaccinating their populations by the end of certainly the third quarter. The U.S. will probably be largely done at the end of this quarter, the second quarter, which means we're going to move from not vaccine consumers to vaccine exporters. And we're already sending all of our AstraZeneca stuff, I think, to India as it is. So I think there, in a year time frame, the health crisis picture in emerging markets, and particularly those countries that you pointed out, should get better. And then the cyclicality trade is there. That should be very supportive for their economy, for their markets and the broader economy. And then the weaker dollar should help. So, your horizon has to be more of a 12-month horizon than a 3-month horizon, which I would argue it always should be at least a 12-month horizon. Nailing timing within a 3-month increment is a really, really difficult thing to do. And I think that the probabilities are that you're going to be happy owning emerging markets in a year's time. There's going to be a lot of white noise and a lot of volatility, as there always are. One of the reasons the emerging markets tend to outperform in the long run is they have higher volatility, and you get paid for that. But it's a mixed picture, but in general, a positive picture. But you got to continue to watch that space. The cycle, I mentioned this before, but the cycle is very, first of all, growth as it relates to just global growth, and this is heavily dominated by the States. I'll just tell you that number is so out of whack in terms of growth being really expensive relative to value that even significantly longer than the long-term average relationship. That's the U.S. driving it almost exclusively. It's those 10 companies driving it, in fact. But growth is very expensive. The other thing is that when you see in the far right various aspects of that reopening environment, that recovery environment, every one of those kind of ticks the boxes. Value outperforms when high yield spreads fall. When short term, when the yield curve is steepening, when government spending is high, and it's extraordinarily high at this point, following a trough in the business cycle. So all of those, there's a lot of cyclical support in our minds for value stocks over growth stocks over the next 12 months, and maybe a little bit even longer, but certainly over the next 12 months. And even though we've seen a pretty significant recovery, it was such a deep hole that the recovery that we've seen so far really hasn't gone very far in terms of filling that hole of values, massive lower valuations relative to growth. Equity markets, I think this is really kind of reiterating the cycle valuation and sentiment construct that we use in looking at relative opportunities. And from a regional perspective, our view is that everything is expensive, either slightly expensive or really expensive, depending on where you're at. But in every case, we also think the economic cycle, the broader cycle, not just the economic, but the policy cycle, the earnings growth cycle is very positive for the US, Eurozone, and emerging markets. And sentiment is positive for the US, Eurozone, and emerging markets as well. And that's a huge support structure for equities in general. But the relative valuation and the cyclicality of non-US give them the nod from a regional preference standpoint. We think, going back to the yield conversation, our view is that the 10-year is likely to trade in kind of a range of 100, kind of 130, maybe even as much as 150 to 200, but 130 to 180, and get that kind of central range. We're square in the middle of either one of those right now. So we'll see some volatility, but we really have trouble seeing, unless this bullish scenario really takes effect and is even more extraordinary than we expected, we really do have trouble seeing the 10-year US Treasury hitting and maintaining a number above 2 for any length of time in the next 12 months. Something to watch, but that's our expectation. The other thing I think that I was asked to comment on was just globalization in general. There's been a lot of discussion that the pandemic is going to kill globalization. I think those are people that are making that comment with an emphasis are probably have not looked at what's been happening over the last 10 years. Globalization hit its peak roughly right before the global financial crisis. Ever since the global financial crisis, the pace of globalization actually has been retrenching. And that's not enormously surprising. But we see basically exponential growth in globalization for most of the 20th and early 21st century, and certainly in the last, by multiple measurements, the rate of globalization has fallen pretty significantly over the last decade. Trade is right there with it. Trade is not growing as quickly as a percentage of overall GDP as it had been, and I think with that, trade tensions are likely to continue to be high. As the pie grows more slowly, being able to win a bigger slice of the pie is going to become more important than just sharing in a quickly growing pie in size. So I think you can expect more. The trade tension that we're seeing of late, as exemplified by the US versus China trade relationships. But Australia, as you know, is in a huge squabble with China as well. Those tensions are likely to continue because the pie is just simply not growing as quickly as it had been as a percentage of global GDP. The US and China have a love-hate relationship. We're irrevocably tied. But our largest trading deficit is with China in the States. And history is replete with examples of the two largest economies in the world not getting along particularly well. In many cases, those have actually ended in armed conflict. We're hopeful that will not happen this time. It's never in anybody's best interest that happens as a general rule, but this tension is historically what's been the case, and there's no reason to believe that that's going to be any different. And this tension between the US and China will continue. I think there are people in the United States, maybe even in your part of the world, that were thinking as Trump was defeated and Biden took power, that there would be a meaningful sea change in policy, U.S. policy as it relates to China. That was not our expectation. That is not really the expectation of many people in Washington. There are very, very few areas in Washington, D.C. politics where there is bipartisan consensus. One of the very few places where there's bipartisan consensus is China and China policy. The stylistic differences between the Trump administration and the prior Obama administration are clear. I don't need to highlight those for all of you. The stylistic difference of the Biden administration is extraordinarily likely to look more like the Obama administration than the Trump administration. I would characterize it as some of the histrionics will be less pronounced, but important to note, the policy is probably not going to be that different. Trump's policies were not wildly different than the Obama policies that related to China. The Biden administration's policy, the tone of the rhetoric is different, but the Biden administration's policy towards China have not changed really at all as it relates to China, nor are they expected to change meaningfully. There are many people, not just in the US, but globally, that think China has not been playing a fair game. And now that they're the second largest economy in the world, I think there's going to be increasing pressure globally and certainly within the US to get them to behave more within the rules of the established game. Obviously, they would massively argue at that point. But we are going to see tension. That tension is going to play out. I know that the fishing rights, as it relates to New Zealand fishing rights, and China's potentially violation of those fishing rights is an issue. It'll be interesting to see. I mean, the U.S., as you know, and has already done, has a vested interest in helping New Zealand maintain the sovereignty of their fishing rights. And that's, I hate to tell you, that's not altruistic on our part and caring about the New Zealand fishing industry. It has everything to do with making sure that we check China's influence and expansion on a global basis. So our foreign policy, our military presence is shifting more and more from a focus on the Middle East as we become more energy independent to a focus on Southeast Asia as China becomes more and more of a player from a defense standpoint, a regional political and influence standpoint, and certainly from an economic standpoint. That tension is not going anywhere soon. So that may be welcome or unwelcome news to all of you, but it's just how things are going to likely play out. And in summary, just to summarize, risks remain in 2021, and the majority of them relate to viruses, the virus path, and mutations. But so far, the vaccines, the Novavax vaccine in its testing in South Africa and in Europe has actually shown a great deal of efficacy to the UK and South African strains of COVID. So far, the vaccines are holding in terms of their efficacy in the face of these mutations. If that were to change, obviously the game would change dramatically. The economic cycle is young, and that has meaningfully impact on what you can expect. That is a massive support function for equity markets and risk asset markets in general, to include credit and kind of the whole spectrum of risk assets, commodities, real assets, kind of the whole ball of wax. The reason to buy financial assets at this point isn't because they're cheap. Bonds are expensive, equities are expensive, nothing is really cheap at this point. You can maybe make a case that some of the commodities are cheap, but and they are, people who are in that industry are. But as a general rule, those aren't really financial assets, those are physical assets, and financial assets are just not cheap. The best opportunity on the board right now appears that you can differentiate and really identify and exploit is value stocks. Those more cyclically oriented, more reasonably priced stocks, I think, are definitely going to be the winners of 2021. We don't think inflation is going to be a 2021 problem. Globalization has been waning and will continue to suffer for the foreseeable future. The China-US tension isn't going anywhere. In fact, the China-everyone tension probably isn't going anywhere anytime soon. There's a lot of uncertainty around the path of a lot of different things in various scenarios. But as always, with very few obvious opportunities, diversification is a really good idea in terms of an investment strategy. It always is. But I think I think people would be well served to remember that in 2021 and not get too carried away with the kinds of results that we've seen in the last year. I'll stop there, Matt, and see if there's any other questions.
Yeah, thanks very much, Eric. That was a great session. Just a reminder, Q&A button down the bottom. You can ask some questions. We've had a few come through throughout. So one sort of consequence of the incredible rally in assets, and whether it's stocks or bonds or real estate, is the gap between rich and poor has widened. We've seen that in the US, but it's the same story here with housing and UK and Europe, etc. What are your thoughts on that? Biden started to have some more progressive policies, but what are your sort of overall thoughts on that gap and how it might impact markets going forward?
So I think the impact on markets going forward is going to be very muted until they're extraordinary, right? We all know what history tells us about that gap. There's if it gets to the point of no return, it ends with people's heads, being chopped off in the square, to be very graphic. But that's, it ends in tremendous political upheaval and political instability. Now, I at this point, you have to be alarmist to say that we're there. But I think that general understanding is going to inform policy, and you're already seeing it in the Biden administration, right? I mean, if you look at the two new packages that they've outlined, it might as well just be called the soak the rich tax strategy, right? It's going right after, it's effectively doubling the capital gains tax for people that have incomes in excess of $1 million. They've raised the income level to $1 million so that in their minds it politically won't be questionable that they're going after really rich people who have disproportionately benefited from this cycle. So you're seeing that, and there's a tremendous amount of support from the progressive part of the U.S. to do that. I think in general there's broad support for that, although it's going to end up in partisan terms. But I think that pace is kind of inevitable. That eventually it's going to be tax policy primarily, and regulations that drive the closing of that gap. Capitalism is a spectacular. It is by far the best system we have ever, in my mind, designed as human beings to allocate capital efficiency. But that doesn't mean it's perfect. It actually it is far from perfect. And it has some very predictable flaws. And those flaws basically are, if you geared a system to survival of the fittest, and that's what you're benefited for, looking after your own self-interest, which in a very callous way, that's what capitalism is built. If you violate the social contract where the rich need to take care of the poor and the powerful take care of the weak, that causes massive instability. So I think what you're going to see, certainly in Europe, you're not seeing the same thing, although you're seeing the gap widen. They've done tons of things relative to the US in particular to address some of those inequities. But the US is going to start moving that direction, and it's going to be regulatory policy and tax policy that hits it. There's a lot of people arguing that the cap gains tax is going to really have a major negative impact on the stock market. I think it'll have a short-term impact, but my question is, what else are you going to buy? Because every asset you can buy is subject to this capital gains tax. It's not like you can buy real estate and not be subject to it, or buy something else and not be subject to it. It's across the board. Any capital gain is priced at that, regardless of what the underlying asset. So it's a great question, Matt. But it's going to frame our political debate for the next decade at least, and probably much longer than that.
Okay, great. Well, thanks, Eric. That was a very good session. I think we'll call it quits there. And just a reminder to everyone, as I mentioned, 8 or 9 sessions over the next couple of weeks. The session tomorrow should be a good one. It's me here asking the question, are we all guilty of greenwashing? So encourage you to get along to that if you are in Wellington. It's going to be at the Sofitel at 3:15. And if you're not in Wellington or can't make it, you can, of course, join online. So thanks again for showing up, and we look forward to engaging over the next couple of weeks. Have a good day.
Thank you all.